talking about how borrowers are underwritten, and one of the most important aspects of underwriting is evaluating credit, the credit worthiness of a borrower. As we've talked about, credit scores are one of the leading determinants of whether people can get a loan from a government-sponsored enterprise, Fannie Mae, Freddie Mac, or from a bank. And so it's worthwhile understanding credit more deeply. And for that, I can think of nobody better than our guest today, Amy Cruz-Cutts. I've known Amy for a longer period of time than either of us would probably like to admit. I first got to know her when she was a professor at Syracuse University. Since then, I actually had the pleasure of working with her at Freddie Mac for about 16 months. She was deputy chief economist at Freddie Mac, chief economist at Equifax, and knows all things about credit scores. So Amy, thank you very much for joining us tonight.
Sure, my pleasure.
So Amy, let's just start with, if you could take a minute to tell us about your background, and then we'll get down to business.
Sure. So I started my life as a public finance economist at Syracuse, looking at income distribution and public housing and other subsidy programs on the what we call the expenditure side of public finance, not the tax side. And then went to Freddie Mac and had a very long, great career there. It was probably the best university I've ever been to in terms of the staff that were there, who knew more than anybody else about housing finance. 8 years at Equifax, which was also a phenomenal experience, and I've been on my own for about 18 months now as a freelance economist, and that means I can speak my mind, which is great.
It's one of the reasons I'm having you on, Amy, is I know you don't, not only, I mean, actually, one of the things I've known about Amy for years is even when she should pull her punches, sometimes she doesn't, which is, I think, one of the great things about her. So let's talk a little bit about the construction of a credit score. So could you just walk us through, so everybody in this audience knows, I think, what their FICO score is, but I don't know that they know where it comes from. So if you could talk us through, how are these things built? That would be very helpful.
Okay. So at its most basic level, they take a consumer's credit history. Actually, they take millions of consumer credit histories. So Equifax, TransUnion, and Experian are the three what we call national credit bureaus. And they provide anonymous data to FICO, and FICO builds models on it. The same thing happens at VantageScore, their only major competitor. They take all of those credit reports. And if you haven't ever looked at your credit report, now would be a great time to do so. In it is every account you've opened at a bank, and many finance companies, though not all, report to credit bureaus. One of the things that is unique about the United States with respect to credit reporting.
Excuse me, just a quick clarification. When you say every account with a bank, you mean a credit account?
Credit account, credit, not your savings. Also are reported, but differently. Okay. In the United States, credit reporting is voluntary on the part of the lender. It is not required by any laws. And it started a very long time ago in the 1800s as a way, it's all about reputation. So what they do is they broker trust. In any event, your credit accounts are reported to the credit bureaus and in a file. So in it would be the date that it was opened, what the high credit, so if it's a credit card, think of your credit limit, whatever that is at the moment, your credit limit. On a mortgage or another installment loan, it would be the opening balance on that. Sometimes interest rate is reported, but that's not usually a required field, and terms, term length, and so on. They then report every month whether you have paid as agreed, are you current on the account, how many days late you might be, 30, 60, 90, 120, is it in collections, have you been referred to foreclosure, have you filed for bankruptcy, and then there are, I don't know the exact number, but hundreds of what they call special narrative codes. And the special narrative codes provide additional information. The sad thing about this is, as old as credit scoring is, It came out of the era when every byte of computer storage was very expensive. So they compressed all of this information into just a few bytes worth, and that's where these special narrative codes come in. All of that credit reporting is dictated by the Consumer Data Industry Association, which is the trade association for credit reporting. They set up the codes and how they're reported in. So all of that information that's been reported in on your account, how much credit, the balance that you have on it this month, whether it's jointly held with someone else or if there's another user on the account, just trying to think of all the various things. All of that information then goes into the mixing bowl of credit scores. It starts off in its most basic, go back to the original scores, they were a simple logistic regression. What is the likelihood that a consumer will go delinquent on an account in the next X number of months? 6 months, I believe, is the target for FICO scores. But credit behaviors, like so many things, are learned behaviors, that what you do over time sort of has some lingering benefits. So we could look at mortgage loans 5 years out and the credit score would still be predictive, though not as powerful as it was maybe at origination, but it still indicates something about your likelihood of default. But today, the most advanced credit scores are very, very complicated. They took that simple logistic regression, trying to estimate that simple probability. They changed it into what they call a cascade model. So you kind of get sorted into a bucket before they even evaluate your score. As an example, if you don't have very many credit accounts, you would be called a thin file borrower. And you don't want to be in the general population model because you don't have a long history behind you. So they might put you in the thin file part of the cascade to estimate that score. In the end, they've weighted all those cascade models together to come up with this likelihood of default. They then convert that into a scale. The scale runs 300 to 850, with most borrowers falling between 600 and about 750. That's where the meat of it is. And in fact, 700, I think, right around 700 is about the median of those scores. So most people are pretty good at paying their bills. They weight things like on your credit card, how much of the credit card credit limit is in use at any time. If you had 3 cards, it would be far better to have, I'm assuming they're all equal in every way, that you have 1/3 of your credit limit used on each card rather than 0 maxed. Okay, so certain behaviors, they don't like to see credit cards maxed out. They certainly don't want to see delinquencies.
And Amy,
and then, yep, go ahead.
Let me just ask, because that's, I think, a really important point. Is there empirical evidence that, I mean, if you still have the credit capacity, right? If you're at 100% 0, you're basically, your unused credit is the same as if you were 1/3.
Right.
So is there any empirical evidence that one is better than the other?
Yes, in that, so these are things I have not, FICO has never revealed to me the secret sauce, but I have worked on Freddie Mac's automated underwriting system. So I know that when they generate these scores, they are looking at every combination they can find to get a little more lift out of the model. And the difference between the people who max out their cards versus the person who, 1/3, as an example, tends to be less risky. Having said that, the penalty for one card maxed versus 0, we're talking, that's probably the difference between a 700 and a 701 versus somebody who had everything else equal and a 30-day delinquency, right? So these things matter. And the other thing that sometimes, well, a lot of other things matter. Recency of credit. Have you applied for a lot of credit recently? Have you, the types of credit. So that was a big thing, maybe, gosh, when I first came to Freddie Mac, one of the big things that they didn't like about FICO scores was that people who had an account at a finance company versus a bank had lower scores, all else equal. So you have everything else equal in terms of numbers of accounts, total credit outstanding, so on. The finance account would create a lower score. Well, part of that is if you think about where finance companies are in the food chain, there are finance companies like credit card issuers who just do credit cards, but they're not a bank. That's a relatively new development versus household finance, which was, again, 20, 30 years ago, a way for people with marginal credit to get access to credit markets and therefore were deemed higher risk, all else equal. I think if you look at scores today, that difference is largely gone away, that so many other things have been found to be more powerful, especially as these models are better at segmenting risk. I found in the research that I did at Freddie Mac, as an example, a 620 borrower who would be viewed as on the edge of between subprime and not, who went to a regular bank to get a mortgage loan versus a 620 borrower who went to a mortgage company that specialized in subprime loans, behaved differently. Those two things were very different. Kind of which door did you go in, door A or door B? Those kinds of behaviors turn out to be very, very powerful. And it's one of the things that we find today with finance, so-called fintech companies, these finance companies that have been born of the internet age, that are non-banks, we apply online and all of these kinds of things. They've hired a lot of very good engineers to come up with models to predict behavior. And you've heard this from Zuckerberg, who said, I can predict credit behavior off of your Facebook account. And the reason I bring this up is because some of your behaviors, the company you keep, as an example, the university that you go to, could be very strong predictors of your credit performance, but they are not allowed under the Fair Credit Reporting Act. So this is kind of a segue, Richard, into how credit scores are created. I can give you hundreds of variables that would be very strong predictors of your credit performance that are not allowed by federal law because they are in violation of the Fair Credit Reporting Act, the Equal Credit Opportunity Act, the Fair Housing Act, many of these anti-discriminatory laws. And then there's also the Court of Public Opinion. Even if it was legal, but it was sketchy, I probably wouldn't want to put my company's reputation on the line on the basis of this variable, because anything out there now is going to be small lift relative to what, I put this in the legal space, would be of very small lift compared to what we have already in the credit files. Having said that, the most important things about your credit score are going to be things like how long have you had credit? How many credit accounts do you have? More is better in the sense that your ability to manage credit, it's one of the things that affects both young people and very old people, is that because you don't have much credit, how do I know that you're a good credit risk? So you kind of have to have enough to do that. The first credit card is very important. The second is even better. Once you get, 4 or 5 accounts, we start to trust that we know you pretty well and can verify that. Certainly, the capacity matters. How much of that credit limit that you've used. Coming out of the Great Recession, the laws changed rather dramatically with respect to granting of credit without verification of ability to repay. So, having said that, and I bring this up because, as Richard knows, in the financial crisis, what led to that, I wouldn't even call it underwriting, because basically the mortgage market abandoned underwriting. And what happened was house prices were rising so fast, you didn't need to verify collateral. You didn't need to verify capacity because house prices were rising fast enough, you could refinance out of trouble, take out some cash in that home and use it as an ATM to fund this house you really couldn't afford for a while, all underwritten on the basis of a credit score. But remember that any model in an econometric sense is based on all else equal, that the market didn't change fundamentally. But when underwriting abandoned those other important pillars of the marketplace, credit scores became worth a lot less. because they were based on that capacity would be underwritten, that collateral would be verified. And so then the credit scores became less valuable from that standpoint. So, long-winded way of saying credit scores are a statistical model, that they are weighted on the basis of the information that's in your credit report. It's not as simple to say a 30-day derogatory on a mortgage is worth 2 times the derogatory on an auto loan, or that it's worth 6 points or 20 points or 100 points on your score, because it really depends on all the other things in your credit report. They do a look back about 2 years. The data that they're looking back is really covering the last 2 years of performance. Really other critical things to note is that by federal law, this goes back to the Federal Fair Credit Reporting Act, from the date of the first derogatory on an account, that would be the time you first went 30 days delinquent, that derogatory has to be erased at 7 years. So you might go delinquent on a mortgage. So think the great financial crisis. You go delinquent on the mortgage. You go through foreclosure. It's not 7 years from foreclosure. It's 7 years from the 30 days derogatory of when that negative information has to be deleted from the account. The existence of the mortgage will still be there. It might still say closed negatively, but all of that length of history goes away and is deleted from the account.
So so 3 questions I want to ask you. So first is just sort of a technical detail. So on the mapping of your the statistical model to the score, I assume what goes on is that you rank everybody from lowest risk to highest risk, and then you somehow assign a score to that. And is that just some sort of normal distribution or log normal distribution, or how is that set up? Because as you said it, you have very thin tails and a lot of fatness in the middle. So
right,
distributionally, how does that?
So they really, I meant to look this up before. It's a mathematical formula. There's no magic in that part. It's just a straight mathematical conversion where they take the logistic regression probabilities that come out of that. I can't remember if they map it to an odds ratio first, but there's a conversion where they multiply it into that score.
Okay. All right.
So it's a straight conversion. There's no magic in it.
Okay. The second thing on the 7 years is, so foreclosure disappears from your credit score after 7 years. And again, I didn't know this till just now. It's when you're first 30 days late.
Right.
So it may have been only 5 years
3-4 years
since the foreclosure actually happened. But like Fannie and Freddie are still going to look at that event and still judge you negatively based on that event, independent of what your FICO score is. Is that correct?
Anything in your credit report is fair game for them to evaluate separately.
Okay, so,
but it would be deleted from your, so that foreclosure that happened in the Great Financial Crisis is no longer on your record at all.
But Fannie and Freddie can still look up, right? These things are recorded.
They could look up in their own accounts, right? So
yeah.
they could view that. Yeah, absolutely. They don't share that information, but if you had a Fannie loan before, Fannie might say, oh, we're not going to give Richard Green a loan because he went through foreclosure. Yeah, burn me once, right? Kind of thing.
Yeah.
So yeah, anything like that could be used. And that's a very important thing because Fannie Mae no longer uses credit scores. I can't speak to Freddie because I haven't asked Freddie, but Fannie Mae no longer uses credit scores in their automated underwriting system. Back a long time ago when I was at Freddie Mac, we tried to engineer a automated underwriting system. So it's like a credit score, right? You're evaluating all these things, but that would include the loan to value ratio and capacity and other things without using credit scores. And we found the credit scores still provided meaningful lift on top of the variables in the credit report. Fannie Mae has now changed their underwriting completely, their automated underwriting system, so that it does not use credit scores at all. They are used after the automated underwriting system for pricing the add-on fees.
The loan level price adjustments.
Exactly.
Which
but not in the whether we would approve this loan or not.
So I before I get to my third question, then I just read. So my understanding is they're still using FICO 5 for that.
So-called FICO Classic. Yep.
Yeah, and we're now at FICO 9, and when I've talked to FICO, they tell me they come up with a new one every 5 years, which means that we're using a 20-year out-of-date score to price loans. Could you comment a little bit on how FICO has evolved and why it might be important to use?
Well, it's not just FICO. It's not just FICO. Importantly, VantageScore was created by a joint effort from the 3 credit bureaus to compete with FICO. And I'm a free markets person. I firmly believe that you need competition. Competition is healthy for everyone. The reason why they're not using these more advanced scores is simply because of inertia, that this stuff kind of gets baked into all the systems. The FHFA tasked with some things coming out of the Dodd-Frank legislation to look at opening up the underwriting at Freddie and Fannie to use VantageScore, other scores, competing scores, not just Vantage scores. There could be a third company out there that creates a score. And I'm firmly of the belief that the best score should win. Whatever that is, that's the one that should be used. And it might not be the best score for everybody, meaning that I might segment one market one way and one market a different way and use a different score. Having said that, John Gibbons, a former Freddie Mac executive, really thought that this would be a problem in the capital markets, that they are so used to looking at these loans and trading these loans on the basis of the FICO score that's been in existence, that he thought that this would create a disruption. I think that actually it just is, in some sense, an unwillingness to invest in the infrastructure to make the change. Lots of changes happen, but they just don't want to do that.
Yeah, you know, FHFA made an argument too. So they ultimately decided to stay with FICO.
Yeah.
But the argument they made, I thought, was a silly argument, which is there'd be a race to the bottom if you had competition in this market. And I'm not sure where the incentive for this race would take place, because it ultimately is Fannie and Freddie that determine pricing. And that pricing, by the way, you can be approved for a Freddie loan or a Fannie loan, but you still might not want it because the FHA loan might be better. Because when you add on these pricing characteristics,
can get expensive.
Yeah, you make them expensive. So I'm just not entirely clear where that race to the bottom argument, how that worked.
Well, if you look at the comments that came in, I think that was it's ultimately an excuse rather than a meaningful argument.
But I think the thing that bothers me, and so if you'd comment on this, I'd appreciate it. You can tell me I'm wrong. Is I'll give an example of a way that FICO 5 really, or FICO Classic really bothers me, is it doesn't differentiate between credit events that happened as a result of shocks exogenous to the household and those that really reflected behavior. And the example I give is, suppose your kid gets sick and they have a procedure that's not covered by insurance and you just can't pay. Mm-hmm. And so you have this collections plan on your record, and that really kills your FICO. Compare that to somebody who buys a Camaro on a 100% loan and crashes it within 2 weeks and then defaults on that auto loan. Okay, they're both defaults. FICO Classic doesn't differentiate particularly well between those defaults, and yet one thing actually reflects attitude toward credit, the other reflects somebody getting a bad hand dealt to them and trying to make do as best they can. My supposition is, and I actually do have some evidence, but I can't really I can't share it with people, is that family with the sick kid is a much better credit risk than the guy who crashes his Camaro. And so that lack of differentiation to me is a real problem. Yeah,
I'll give you a better example. The reason I say this is that medical collections are no longer reported by credit bureaus. They have elected not to do that. Now, if you put it on your credit card and you default on the credit card, it's still the medical, so it's still a medical expense. Impact may be the same, that you defaulted on it, but it's not tagged as a medical collection. So things that are tagged as medical collections are not used in credit underwriting. Relatively new. I'm not saying this was always the case. This is more of a relatively new thing. Having said that, we experienced Katrina and all these people who stayed in their homes. The homes were flooded and, condemned. And the insurance wouldn't cover it because of the type of event, like wind events are not covered or flood events are not covered, but wind is, and, depends on which kind of hurricane hits you. Those kinds of things really do test people, right? And some people will fight for that and make the payments and scratch the money together, and other people view it as, a contract to be broken. So very different behavioral characteristics of those two types of people, the people who walk away and the ones who make payments on that. And I agree. Well, independent of the moral aspect of what you've brought up, I simply think that anytime we are not using the very best information available to us and the very best models available to us, let's forget for a moment the consumer side of the pro-consumer view, and let's do the pro-business view. What they're doing by not allowing these better scores into there is, from a business perspective, I'm saying yes to borrowers I should say no to, which means that I'm not allowing in borrowers that I should say yes to, right? The swap in of the goods and the bads.
And in fact, you may be making and it's not just that, it's that you are, this is, I think, one of the elements that leads to disparate outcomes is you will have, and the way these things work is non-Hispanic whites will score better than people of color, even if the person of color is a better credit risk.
Yeah, and that's where these cascade models become, when FICO does these new models, it's because the cascades get better at siphoning people into the right model, the models themselves get better, the use of information. I'll give you an example. Recent innovations in credit scoring, and this is one of the things where it's technology as well as evolution of thinking. We knew about the value of trended data a long time ago. Freddie Mac has been using it for 25 years. That was in their early indicator for loan default. So loans that had gone late, you want to know which ones you prioritize in trying to get money from people, calling them and saying, hey, what's going on? You don't want to do all your calls on the first day because some people just were out of town, they're going to mail their payment. Other people, you want to catch them first thing. The trended data is not just to look at, are you 30 days late now? It's what were the balances over the last several months? How were your payments timed? That sort of thing. We want to look at the trends in that, not just the static in the moment. Well, it's not that we didn't want to do that. It's that you need massive pipes to bring that information in. Right, so you're not sending a static credit report, you're sending snapshots, multiple, it's, the difference between an X-ray and an MRI. That kind of information intensity is what trended data is all about. The newest credit scores take advantage of trended data. Had to have the pipes to do that. So these are technological innovations, not that we didn't know about it, we just didn't have the infrastructure, the technological infrastructure to make it happen. So I look at these things and say, we are shortchanging consumers, we're shortchanging lenders and investors. So the whole economy loses out when the wrong people get loans and the right people are denied access to credit. So it's a big deal.
On that point, talk a little bit about thin files.
Okay.
And, there's a view, basically the way, again, traditional FICO works is that there's limited information. We're going to just treat you as a bad credit risk.
Right.
And so you have somebody who lives, they pay their rent, they pay their utilities, they manage to save some money, but they don't have credit cards. They're not going to have a good FICO score, so they're not going to have access to the best quality credit. Is there something we could do about that other than telling people that they should go get credit cards?
Well, another example is somebody who just moved from Europe to here. The head of Oxford Economics, a very prominent organization, very great consulting firm, came over from the UK, couldn't get credit. Guy, making $500,000 a year, couldn't get credit. And the reason for that is simply, well, how do we know we can trust you? So it starts off with several things are happening at the same time. One is anything you can do to get that first credit card, that's key, getting the first one. After that, you work on getting the second one, and so building up that. What we're starting to see more of, which is very good, is we mentioned earlier about, you said banks only report credit. They are now starting to report and use within their own underwriting. So if, for example, you have your bank account with Chase, automated deposit into Chase, Chase will use that income, that automated payment in there to underwrite things because they verified your income through this behavior of money into the account. So if you have a job, that sort of thing. They are looking at payments for rent. They'll look at your checking account, information in the checking account about rent payments, and they will use that. Now that's proprietary to your checking account at Chase or Wells or wherever, that specific lender. More and more of this information is getting reported to credit bureaus. Equifax has a proprietary database that they are the stewards of, not the owners of, but the stewards of, called the National Consumer NCT Telecom and Utilities Exchange. That is wireless companies, so Sprint, Verizon, those guys. A lot of, but not all of, public utilities. So think of your power and your gas company and so on. And then telecom utilities, cable bills reported into there. And then there are other databases that there are companies, and you can find these online now, that are go-betweens between a landlord and the renter. And the difficulty with collecting rent information is that you can go to a corporate office and maybe get 100 or 1,000 throughout all their properties of the renters and report that to a credit bureau. But much of the rental property is done on mom and pop basis, right? So you can't get it in a single place. So what these companies have done, this is a great innovation in fintech, is companies where the renter pays this fintech company, the fintech company pays the landlord, they get a fee for this. They might do some other things for the landlord, like manage the taxes or something on the property. And then they send a note to the credit bureau that the renter paid their rent. So there's something in it for the borrower, something in it, the consumer, something in it for the landlord. And that's a way that more of this information is getting reported to credit bureaus. So it's not that we don't want to use the rent or provide that to them, it's that it's been very hard to collect it. So as more of that gets used, it's better.
So I'd like to finish up with a question on sort of credit scores and social disparity, which is something that has become an issue I'm grateful that everybody is talking about now. So I think about the following, and forgive the personalized story, but when one of my kids went to buy a car for the first time, she asked me to come along so that she wouldn't get screwed by the dealer. She didn't actually need me. She did just great on her own, but I was in the background. And I learned what her credit score was, and it's very good. And I'm thinking, yay, good job. You've been responsible. And she has been. But here's the thing, is she had her college paid for by her parents, just as I had my college paid for by my parent, which means it's really much easier to manage your credit. You make some income, you save some income, you get a credit card, you pay your credit card every month. And and again, I'm very proud of my daughter. She's done great, but she had an enormous advantage, just as I had an enormous advantage. For people who come out of college with lots of loans, and these are disproportionately people of color, or people who don't go to college at all, and so they can't get that really well-paying job out of high school. Building that credit is just much harder to do. Building that credit score is just much harder to do. It doesn't reflect a difference in character. It reflects a difference in initial condition. And so in that way, credit scores continue to, I think, exacerbate these unequal outcomes that are a real problem in our society. Is there anything we can do to address this while at the same time recognizing the legitimacy of making loans to people who can pay them back?
So I will back that up a little bit. I've looked at stuff I did at Equifax because one of the databases they have is payroll income, so we could compare income things. So it is uniformly true that people of higher income have average scores that are higher. This is just a tautology. The more money you have, the more money you have left over for discretionary things. So once you've paid for the basics, you have more money left over. That said, many people of lower incomes, have great credit scores. So it is not, it's not black and it's not a simple thing where I can map your income and I get your credit score. That's definitely not the case. Having said that, credit scores are not the problem. They are the result of the problem. They then are an intermediate step to exacerbating the problem. So, we've talked throughout discussions of racial disparities, the lack of wealth, generational wealth, right? The stepping stones that have been deprived of people of color for 500 years now, right? The lack of property ownership, the lack of disproportionately low college rates and so on. So all of these things, right? Income is lower.
And it goes back to like access to FHA and the HOLC back in the 30s.
Exactly. Right.
If you had a loan in 1937 that was in technical default, which is what most of the mortgages were, and you were living in a black neighborhood, which likely meant you were black, you couldn't get relief from the Homeowners Loan Corporation, whereas if you were in a white neighborhood, you could. So the white people got to keep their houses, the black people lost their houses. Right,
and that stripped that generation of wealth. Right, and so this just it has perpetuated itself to today. This is an incredibly important thing, and I feel very passionately about it. There's some things that have come out. This is a great natural experiment. If you want to know what the impact is of negative information on people's credit scores and their ability to gain credit, the CARES Act amended the Fair Credit Reporting Act. All federal student loan borrowers were automatically put into deferment through September 30th. And if they were delinquent on their account, there's a little asterisk on that. If they were delinquent on their account, it gets marked current for the period of the accommodation. Now, coming out of that automated thing, if you've lost your job, you can go into a regular deferral, or apply for the, and then they have the income-based repayment plans and so on for student loans. New York Federal Reserve Bank, looking at credit scores, all student loan borrowers, the average FICO score went up 10 points between March, when the CARES Act was enacted, and today. So that's not just of the borrowers that are affected. I think if we looked at the borrowers who are affected, their scores went up by a very large amount. The asterisk I put on that is $300 billion worth of student loan accounts are not on credit bureau files because they've gone into default and have gone back to the Department of Education. So it sits on their portfolio. They can garnish wages, they can take tax returns, they can do all kinds of nefarious things to get the money back. That's no longer reported in the credit bureaus. So that part is still out there. The Freddie and Fannie fee. So by the way, the rest of your credit accounts, if you asked for a COVID-related accommodation, so Freddie and Fannie, it's free for the asking, FHA free for the asking. If you have a car loan, a credit card, and you ask for a COVID-related deferral, there is no code. I mentioned these special narrative codes. There is no special CARES Act COVID deferral. Mm-hmm. So they're using natural disaster, they're using deferred student loan, even though it's a credit card. They're using these other codes to indicate this deferral. The if the account is current when it enters the accommodation, it is to be counted as current going forward. This is a dramatic change from what happened in the financial crisis, where if you were in a forbearance on a mortgage, your credit was trashed. That was a negative. The CARES Act expressly says it's not a negative, don't treat it that way. The problem is, what I know is that you are in distress, so you have the forbearance. It's not reflected in your credit account in the normal sense of derogatory. So what did Freddie and Fannie do? They slapped a 50 basis point origination fee on all refinances because we can't trust the information we're getting.
Which, by the way, is absurd, because the refinance loan, by definition, is going to be a safer loan than the loan they have on their balance sheet because the payments are lower. And one of the things we learned from the financial crisis, no, I'm actually very upset about that.
Yes, but it's the price of that uncertainty. There were two bills introduced at the same time as the CARES Act, one in the House, one in the Senate, that would suspend all negative reporting during the nationally declared pandemic crisis. So those have not gone anywhere, thank goodness, because I think that's a terrible thing. What I would rather see, Richard, your question was about racial disparity and credit scores. I don't want to change credit scores. I don't want to change credit reporting. What I want to do is amend the Fair Credit Reporting Act that would allow a small amount of discretion. Suppose I built the very best model out there, but I happen to know that you are Black, and that all the things I have in my model says that you are a 645 credit score. But I also know that your 645 credit score and Black, if I gave you 5 bonus points for being Black, that I could get you into the right loan at the right price, that you are a great credit risk. But I can't do that even for your benefit today.
Yeah.
And that, I think, it's like affirmative action, right? If you turn off affirmative action, then how do I boost people who are ready to take the responsibility of college, right? I don't want to admit somebody to university who's going to fail. I don't want that. I want somebody who's going to succeed to get in. So in the same way that I look at affirmative action, we can't today legally discriminate for someone as well. So that's where I would look to fixing things. I think it will be a better fix.
So Amy Cutts, always great to talk to you. That was an incredibly informative presentation. I learned a couple of things I didn't know, which always excites me. Thank you very much for taking some time with us this morning.
Sure thing. Thank you, Richard.
Okay, see you soon.